Revealing my two buy and hold forever stocks. Nothing is forever, but those are two stocks that I'm planning to hold for at least the next 5 to 10 years, maybe a little bit longer. The first one is a stock that I never talked about it on YouTube. So it's gonna be something new. And I know many of you guys are sick and tired of me talking about hymns and talking about all those stocks. So you want something different, and I'm gonna give it to you. And I really hope you enjoy it. The second one is a stock that I owned for a while. I talked about it. It's a growth-oriented stock. And some of you have asked me for an update and a potential entry on the stock. So I'm going to talk about that today as well. And such videos, they don't get a lot of views. So all I'm asking is please press the like button and let me know what you think in the comments. The first stock, which is a stock that I never talked about on YouTube, and it's been a little bit disappointing recently, is Brookfield Asset Management, ticker symbol BAM. The stock is still down 3% year to date. A lot of stocks are up 20, 30, 50, 100, 200%, and the stock is doing nothing, and it's been really disappointing. It's down 3% year to date. I initially bought BAM on April 4th of 2025, and I said the stock was easy money, under $43. So my cost basis is a little bit lower, and I bought Robinhood as well. I bought them pretty much on the same date. But if you look at the divergence between BAM and BN, which is a parent company, it owns 73% of BAM. It's up like 23% on the year. And Brookfield Asset Management is down 2.6% on the year. I'm going to talk about this, and I personally don't believe this divergence is going to last very, very long. Now, Brookfield Asset Management is an asset management business, so they manage assets of over $1 trillion for a lot of endowment funds, a lot of insurance kind of related businesses, and many different institutions that have a lot of capital, and they want to earn a higher return than, for example, buying the treasuries, a 10 or 30-year treasury. They want something a little bit better, maybe 10, 11, 12%. So they look into alternative investments, and one of the leaders in the alternative sector is Brookfield Asset Management, with over $1 trillion in assets. Now, some of you might believe that $1 trillion is a lot and they have no more room to grow. But if you look at the asset management business in the world, it's crazy. BlackRock has over $11.5 trillion in asset under management. Vanguard has $8.7 trillion. Fidelity has almost $4 trillion. And Brookfield Asset Management is not even on the top 10 or 15 on the list. So the runways for Brookfield Asset Management is large. And if you look at the allocation in general, alternatives make up only 25% of the institutional pool. But in terms of the individual pools in general, so if they expand into 401ks, which they're talking about it, and private wealth and annuities, and just the individual pool in general, it's only a 3% allocation. So the runways on this business in general is going to be huge. The company owns decent returns on a lot of their funds. They invest in real estate, they invest in credit, they actually now own Oaktree, which was founded by Howard Mark, and it's now owned by BN and BAM. And they invest in just many different things, and they earn about a 12% return, 14, 20. They earn pretty decent returns on those investments, and it makes their investors very, very happy. Now, BAM has one of the most simplistic business models in the world. I mean, an 8 or 9-year-old can look at the income statement and can understand pretty much everything around it. They have the management fees, which they collect as a percentage of the revenues. So they have, let's say, 500 billion. They collect a fee on it, just like an ETF has a small fee for the index. BAM has a small fee for managing the money for those partners, and then they get something called carried interest. Carried interest is, let's say, the targeted fund is 12% a year. If it returns 15% a year, BAM will get a performance fee, like a percentage of it, and it's mainly called within the carried interest part of the revenues. So they have 1.2 billion in revenues. Most of their expenses are related to the management and administrative expenses and a few other things. Their total expenses are like 515 million. The company has 58% net income margin, even higher than Visa and MasterCard. Visa is at 54, and BAM has 58%. So it's a very, very efficient business, just like a toll bridge, beautiful business model. And they end up with 692 million. Attributable to BAM is 724. It's really the most simplistic, easiest business model in the world. They have $1 trillion under management, and they manage the money. They collect a fee on it, and if they do better than they expected, they collect even higher fee. And that's pretty much what Brookfield Asset Management does. They have almost no debt, and they have a good cash position. Now, the best part about BAM is that most of the capital in the fund are long term. 87% of it is long term. Some of it is locked in through a 10-year contract. So if we have a liquidity event and some of those investors need to call BAM and pull their money out, they can't really pull their money out before around 10 or 11 years. This is how those deals are structured. And the best part about it is that a lot of the money that BAM manages is owned or managed by BN, the parent company. For example, the parent company BN owns Brookfield Wealth Solutions, which is like an insurance-related business, and BAM is in charge of investing the insurance float that's really owned by BN. So it's like all integrated, where most of it is long-term, 87% of it, and they expect it to be 92%, which is a game changer in this case. If we have a liquidity event, if we have something happen 2008, the investors can't just call BAM and take their money out. They're locked in through long-term contracts, and some of the money is actually BN's money that BAM is managing. And it's just a really beautiful business model, and it sets the company apart. Now, BN and BAM together, they recently acquired the 26% remaining interest in Oaktree. Now they own 100% of Oaktree, which is mainly a private credit kind of institution. They also acquired a majority stake in Angel Oak, which is mainly manages specialty mortgages and consumer credits. That's going to give them over 11 billion in fee-related earnings capital, which is really, really good. And this is the best thing that I can use to explain the BAM business model. Is Brookfield Wealth Solutions, which is the insurance company. It's not BAM, it's the insurance company of Brookfield. They acquired another company called Just Group. Okay, now this is what it says. While BAM is not contributing capital to the transaction or taking on insurance liabilities, we will become the investment manager for a significant portion of the fund. So Brookfield Wealth Solution is putting up the money, they're taking the credit risk, they're acquiring a Just Group. BAM is not taking those risks, they're not putting up the money, but because they're part of Brookfield, they will be the managers of those assets. And there's many different deals where BN is acquiring them, or the Wealth Solution business is acquiring them, but BAM is the asset manager, and they're pretty much benefiting from the transaction without them having to put on the capital to acquire the company to benefit from the transaction. So the whole setup really here is really beautiful, and it's something very, very special. And they even have a deal with the US government where they announced some kind of a partnership of over 80 billion where they want to invest in nuclear plants. And I believe BN owns the Westinghouse technology for nuclear, and BAM is going to benefit from that a lot. So everything has been going really, really well. As I mentioned, they have $1 billion in cash, around $9 billion in investments, and their debt is like $1.4 billion. So they have a very, very clean balance sheet. Now, if all those things are amazing about BAM, and BAM is such an amazing business, then why is there such a massive divergence between Brookfield Asset Management and Brookfield's parent company? Well, this is a hard one to explain, but I believe there's many different reasons. One of them is BAM was trading at a little bit of a premium, and I think the premium is justified relative to BN because BAM does not have the debt liabilities that BN has. BAM has an easier structure in general, better business model in general, and it has a better model. So I believe BAM deserves a premium over BN, but the premium was a little bit too high, and the market is readjusting to the valuation of BAM because it was a little bit high. But another reason why I believe BN has been outperforming BAM is because BAM, before 2025, had a weird shareholder structure where it cannot be included in the S&P 500, it cannot be included in many indices. So there's not many people that can actually own or trade Brookfield Asset Management. And the management of BN have recognized that, which is why in late 2024, they announced steps towards enhancing BAM's corporate structure and positioning BAM for a broader equity index inclusion, particularly those in the United States. So they're trying to get BAM into the indices. The way they're doing it is they changed the office to New York, and they changed the shareholder structure where BN still holds 73% in BAM, but BAM owns 100% of the asset management business. So that's going to make it a little bit better for BAM for it to be included in the S&P 500, included in different indices, and that should help the liquidity on the stock and should help the inflows in general. And even Bill Ackman himself said it in his latest quarterly letter, or I should say semi-annual letter, and he said the company has also made progress in expanding its potential US investor base by expanding its sell side investment coverage and making progress towards Brookfield Asset Management's US index inclusion, which may be a potential prosecutor similar to actions by BN. So BAM, they're doing everything right in terms of the fundamentals. The earnings have been amazing. They're doing a lot of moves, and I believe they will make themselves into the earnings report over the next few quarters. But it's been disappointing in terms of the divergence, and I believe some of it has to do with BAM being a little bit expensive, and some of it has to do with BAM not being in a lot of indices, and it's not a widely traded stock. But with the recent shareholder structure and everything around it, I believe it's going to make BAM a little bit more correlated to BN. And I think BAM over here, in terms of a setup, it looks really, really interesting. In terms of the management guidance, and they have a history of beating their guidance, not even meeting them, they're even beating their guidance. They're guiding about 18% in DE per share. So 18% distributable earnings per share growth. And this is the right metrics that we should use for BN and Brookfield Asset Management. So we're getting 18% CAGR. We're also getting a decent dividend. The dividend right now is about 3.7%. It's almost a 4% dividend. So if we have no more multiple contraction, I believe the multiple contraction has happened. We're getting 18% in DE per share. So that's 18% and around a 4% dividend. That should be around a 21 to 22% annual return for Brookfield Asset Management. But it gets even better because the management team is seeing a potential path to 20% plus annualized earnings growth if they do more acquisitions, which they've been doing some acquisitions, and if they expand the pool of capital a little bit more, they can potentially get 20%. In this case, Brookfield Asset Management, in my opinion, can deliver a 23 to 24% annual return over the next 5 years or even over the next 10 years. So for me, I love the setup on Brookfield Asset Management. I think the divergence has been humbling, but I still believe in the business. I still believe in the business model, and I think it's going to do really, really well. And I think there's a decent chance that the stock has potentially bottomed. This is a chart that I shared in my investment group. And normally whenever BAM goes above a 4% dividend or near a 4% dividend, the stock doesn't stay there for too long and it causes a bottom on the stock. This is when I bought in April. It went above its 4% and it hasn't stayed there. We recently got to 3.91% and we haven't stayed there for too long and the stock reversed. So I think there's a decent chance that the stock has bottomed. So I love the setup from this case, and I love the fundamental setup, and I love the management team, and I love everything about it. And I'm still being patient. I'm the patient investor. So I'm waiting on BN and I'm waiting mainly on BAM. And we'll see what happens over the next 2 to 4 quarters, and we'll see if I end up being right on the divergence potentially closing in, or at least BAM performing a little bit better than it used to. I believe BN will always outperform BAM because they can reinvest some money in themselves, and BAM is paying it out as a dividend. But I like BAM as a simpler investment in general, and I like to have 1 or 2 dividend stocks in my portfolio because I like dividends sometimes, and BAM is a perfect stock for that. So I love it, and I'm still holding it, and that was the stock that I wanted to share with you. Now, the second stock, which I also talked about many times, I'm going to talk about it again, is Mama's Creations. Mama's Creations has been an amazing performer for me. I talked about it at $3 per share on YouTube, and if you look at this chart, it went from $1.74 when I bought it to $11.32. It's been a crazy performance for a stock. It's not really a tech stock in general. It's even a food company. They pretty much sell food, and they sell meatballs, and they sell chicken, which is really amazing. And I love looking into such stocks for my portfolio, and I talk about them, and I share much more of those stocks in my own investment group. But in terms of Mama, they sell food again. It's a food company. You could say they don't have any moat, but the best moat for them, in my opinion, is the management team. And this is why I invested in the company. It was because of the CEO. The CEO came in and he started improving margins. Margins were at 12%. They jumped to 25%. And he keeps saying margin and margin and then margin. And he just focuses on margin a lot, fixing costs a little bit better and improving things in general. I'm going to keep it short on this one. But if you look at the revenue growth for the company, it has been massive. Not just in terms of organic growth, but also in terms of acquisition. And the company has made 3 acquisitions so far, with their latest acquisition being about 2 months ago. And that was a company called Crown Rock, I believe. Crown Rock, they bought it for $17.5 million. The company makes $56 million revenues, so they got a 0.3 time revenue multiple. The CEO has waited 10 months to do this acquisition, and he's very disciplined because he doesn't like to overpay. And he acquired it for 0.3 time revenue, which is absolutely crazy. And the best part about it is that Crown Rock acquisition was a part of Cisco, and they have a new facility, very huge, fancy facility that's like, I believe, 30 minutes away from the Mama's facilities in New Jersey, and they're finding synergies from it. And this is what the CEO said. He said, we do not expect any major capex whatsoever to the Crown business. If anything, we're actually going to take some stuff and maybe that maybe is underutilized. He said, where we were going to buy something completely new, and now we don't have to. I would argue from a system perspective, it's like a net negative capex. They had to buy a lot of meatballs machine and different kind of machines. They don't have to even buy them anymore because the new facility is a new facility, and it already comes with everything, all the shiny stuff, and everything is in it. And they acquired it for 0.3 time revenue, and it's really amazing. And the best part about it, there's many more of those acquisitions to come because the company has a plan of becoming $1 billion in sales company by 2030. The current combined revenue is like 220 million or 250 million. So we're going to see way more of those acquisitions. And most of those acquisitions are funded by cash, but sometimes they issue some stock to do them. So if they issue more stock to do another acquisition, I think that would be an amazing entry on Mama's Creations stock. But even right now, I still believe the stock, despite having a good run, I still don't believe the stock is overvalued. And this is how I'm valuing it. I'm getting $1 billion in sales by 2030 if they do achieve the guidance. And I'm using 10% net income margin, which is a typical margin for a food company. That's $100 million in revenues. And I time it by 20 times earnings. I think 20 times earnings is fair. It's even below the current multiple. If I time it by 20 times, this is $2 billion market cap. The current market cap is 458 million. So I'm still seeing over 336% on the upside over the next 5 years with an amazing company, amazing CEO. And it's not really a tech stock in general. It has performed really well, not being a tech stock. And to me, it's amazing. And I wanted to share it with you guys again. And if you're interested in more timely updates whenever I'm buying something, whenever I'm selling something, I share everything in my own group. This is the link if you're interested. But thank you again for watching. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.